Okay, let's unpack this. If you were trying to understand the blueprint for, well, for the global economy over the next 5 years, you really have to read the core documents from one single company, TSMC. We're diving deep into their fourth quarter 2025 earnings conference. And look, this isn't just a financial check-in. It's a stunning declaration of war, a colossal investment strategy driven entirely by AI.
That really is the mission today. We are translating those enormous numbers, the money, the margins, the technical roadmaps into clear insight for you.
Right.
We're moving past the AI is big headline and actually quantifying it. We're looking at TSMC's unprecedented $52 to $56 billion CapEx plan for 2026.
An incredible number.
And the crucial details about how they plan to deliver 2-nanometer and A16 silicon. I mean, we are basically charting the future supply of everything digital.
And the context for this massive shift, it really matters. 2025 wasn't just a good year for them, it was a structural leap. They announced that their revenue increased 35.9% year over year in US dollars, hitting $122 billion. But here is the key metric. They significantly outpaced the overall Foundry 2.0 industry, which only grew by 16%.
Exactly. And when we talk about Foundry 2.0, we're referring specifically to the leading edge of semiconductor manufacturing.
The really hard stuff.
The complex, high-cost, high-tech sector where TSMC just reigns. So to outperform that entire segment by nearly double, well, it shows that the demand is just disproportionately focused on their most advanced and therefore most profitable nodes.
So let's jump straight into that Q4 2025 scorecard. Total revenue reached $33.7 billion. That's up nearly 2% sequentially.
Which, for a company that big, moving that fast is impressive.
It is, but the real story, for me, is in the margins. The gross margin rose to 62.3%.
That 62.3% is. It's remarkable. And it's a significant 2.8 percentage point increase quarter over quarter. It actually flew past the high end of their own internal guidance.
Wow.
See, when a company is operating at that scale, exceeding guidance by 130 basis points, that's just a function of pure operational excellence.
What specifically allows a massive manufacturer to keep its margins in the low 60s? I mean, that's usually the territory of software companies, not heavy industry.
It was a combination of things. You had some favorable currency movements, ongoing cost improvement efforts in the fabs, but critically, very, very high capacity utilization.
For everything is running full tilt.
Everything. When demand is soaring, every piece of machinery is working overtime efficiently, and that translates directly into robust gross and operating margins, which, by the way, hit 54% for the quarter.
And drilling into where that revenue is coming from, the technology mix is shifting so rapidly away from the older nodes.
The center of gravity is moving, for sure. Advanced technologies, which they define as 7 nanometers and below, now accounted for 77% of Q4 wafer revenue.
77%.
Yeah, that's up from 74% for the full year and only 69% the year before. The company is, it's accelerating its abandonment of trailing edge processes.
And which of the advanced nodes are carrying most of the weight?
In Q4, the 5mm node was still the largest contributor at 35%. But right behind it, the 3mm node is ramping extremely quickly, accounting for 28%.
That's a huge jump.
It's a huge volume increase. And then 7mm accounted for about 14%.
Okay, now let's look at the customer platforms, because this is where we see that structural change really hitting home. HPC high-performance computing is the undisputed leader now.
It is the new foundation of the company. HPC accounted for 55% of Q4 revenue, and for the full year 2025, HPC revenue grew 48% year over year.
48%.
And accounted for a dominant 58% of their total revenue. This is a crucial number because it basically means TSMC is now an AI and server company that also happens to make smartphone chips.
But hold on, if 58% of their 2025 revenue came from HPC, doesn't that make them incredibly dependent on just a few hyperscalers? The Googles, Amazons, Metas, Microsofts, NVIDIAs of the world.
That's the critical tension in their model.
It could give those customers a lot of leverage down the line, right?
It could, and it's why technology leadership is their ultimate defense. Their tech is so unique, so far ahead, that even though the customer pool is concentrated, the buyers have no real alternative.
So they have the leverage for now.
For now, smartphone demand is still substantial at 32% of Q4 revenue, but yes, their future is increasingly tied to a handful of enormous North American players, which is where 74% of their Q4 revenue comes from.
That concentration leads us directly into quantifying this AI boom. We know HPC is driving it, but what specific numbers did they give for the core AI accelerators in 2025?
So AI accelerator revenue, which is the purest measure of the current boom, GPUs, specialized chips, that accounted for a high teens percentage of their total revenue in 2025.
High teens. So we're already talking a multi-billion-dollar segment.
A very big multi-billion-dollar segment, and it explains their genuinely staggering long-term forecasts.
Okay, let's talk about this forecast. The company expects the general foundry 2.0 industry to grow 14% in 2026.
Right.
But TSMC is forecasting its own full-year 2026 revenue to increase by close to 30%. They are intentionally planning to double the industry growth rate.
They're betting big on their differentiation,
Hmm.
but the long-term projection is what truly redefines their trajectory. They raised their AI accelerator revenue compound annual growth rate, the KGR, for the 5 years between 2024 and 2029,
And they raised it too.
to approach the mid to high 50% range.
Mid to high 50s. A KJO for 5 years on a segment that's already high teens of their total revenue. I mean, when a company of TSMC's scale forecasts that kind of growth, what does that fundamentally tell us about this AI cycle?
It tells us they see AI as a foundational, decade-long structural demand shift, not some short-term commodity cycle. And that confidence, it boosts the entire business. Their overall long-term revenue PGR for 2024 to 2029 is now expected to approach 25%.
25%. That's a whole new growth rate for them.
It's a structurally new, much faster, and sustained growth rate.
But that level of projection, doubling the industry rate, expecting 50+% growth, it raises the inevitable question that analysts ask directly. Are we in an AI bubble? Is management worried they're building all this capacity for a peak that might just flatten out?
This is the most crucial qualitative insight from the call. The CEO apparently spent months confirming this demand, not just with their customers, the chip designers, but with their customer's customer.
The cloud provider.
The cloud service providers, the hyperscalers, the ones actually using the chips to train and run these massive models.
So this verification seems critical. Does this mean TSMC is now effectively acting as a risk management layer for the entire global AI build-out? Making sure its clients aren't double ordering in some speculative frenzy?
That's exactly it. They're verifying real demand, not just speculative purchases. And the feedback was definitive. AI is real, it's actively helping these businesses grow, and those customers are, and I'm quoting here, very rich.
Oh, well, that helps.
It certainly does. They're seeing real, profitable returns on their AI infrastructure investments. The CEO even mentioned they use AI internally in their own fabs to boost productivity, which helps their own margins.
So if the demand is this validated, what's the current bottleneck for global AI? Is it power, cooling, data centers?
According to their highest volume customers, the current bottleneck is exclusively silicon from TSMC.
Just the wafers.
They simply cannot get wafers fast enough. Now, the CEO did pause to worry a bit about Taiwan's own electricity supply long term, but for right now, the constraint on global AI is simply capacity in TSMC's advanced fabs.
That perfectly leads us into the record-breaking capital commitment. The CapEx. If silicon is the bottleneck, they are spending astronomical amounts of money to break it open.
This number is really the defining financial moment of this deep dive. Their 2026 capital budget is guided to be between $52 and $56 billion.
$56 billion.
Yeah.
To put that in perspective, that's more than the entire annual GDP of some small nations. It's a monumental step up from the $40.9 billion they spent in 2025.
It is.
So where's all that money going? They're building a new economy every single year.
Well, the allocation is laser focused on the future. 70 to 80% is dedicated to advanced process technologies, shrinking the chips.
Okay.
About 10% for specialty tech, and critically, 10 to 20% is for advanced packaging, testing, and mask making.
That packaging expenditure is significant, isn't it? That speaks directly to AI accelerators.
Absolutely. Advanced packaging is the performance multiplier for AI and HPC. But the underlying reason CapEx is ballooning so fast is simple: the rising cost of shrinking the chips.
Right.
The company stated that the CapEx dollar required to build capacity for N2, the 2-nanometer node, is substantially higher than it was for N3. And they expect the capex for the next node, A14, to be even higher still.
So shrinking the transistor gets exponentially more expensive, but they have to do it. They spent $101 billion in capex over the last 3 years, but now they're saying the next 3 years will be significantly higher.
This exponential cost increase is the ultimate moat. It means any competitor trying to catch up to TSMC's 3-nanometer tech today has to pay even more to reach 2-nanometer tomorrow. It just solidifies their lead.
How does all this massive spending affect their profitability targets? I mean, they aim for 56% gross margin or higher, but building new, expensive fabs overseas has to be a drag.
It creates what they internally call takes, or dilution factors, and they're pretty transparent about two major headwinds. First, the initial ramp-up of the 2-nanometer technology is expected to cause a 2 to 3% dilution for the full year 2026.
Because the yields are lower at first.
Exactly. Yields are lower, costs are high until you hit volume. And the second major take is that global expansion, the cost of doing business outside of Taiwan.
Right, the geopolitical premium.
Correct. The dilution from operating overseas fabs, like in the US and Japan, is expected to widen from 2 to 3% to maybe 3 to 4% later on. But they believe this is still achievable because of their strong puts, or positive offsets.
And those puts are just the previous generation finally hitting its stride.
Precisely. The 3-nanometer node's gross margin is expected to cross over and reach the corporate average sometime in 2026, where it'll generate strong, predictable income. That helps finance the expensive N2 ramp.
Okay, let's shift to the global manufacturing and technology roadmap. We need the details on where these expensive chips will be made, starting with that gigafab cluster in Arizona.
The Arizona project is accelerating rapidly. Fab 1 entered high-volume production back in Q4 2024. Fab 2 construction is complete. Tool installation is planned for 2026.
Okay.
But the most notable update is that due to overwhelming U.S. customer demand, they are pulling forward the high-volume manufacturing schedule for Fab 2 to the second half of 2027.
Pulling it forward. In a multi-billion-dollar project like this, that's almost unheard of. It sounds like desperation from the customers.
It absolutely underscores the urgency. And they're not stopping. They're moving ahead with Fab 3 construction and applying for permits for Fab 4 and a fourth advanced packaging fab. They've even bought a second large piece of land nearby. This is a multi-decade commitment.
And a quick status check on the other overseas fabs.
Japan's Fab 1 started volume production late in 2024. It's running with good yield, and construction for Fab 2 has already begun. And in Europe, the specialty fab in Dresden, Germany is progressing as planned. The global footprint is being laid down.
Now, for the cutting edge itself,
Yeah.
the new nodes. What are the details on N2 and the next step, A16?
So N2, the 2-nanometer technology that entered high-volume manufacturing in Q4 2025 across 2 sites in Taiwan, Hsinchu, and Kaohsiung, and with good yield, they expect a fast ramp in 2026.
And the really forward-looking tech.
That's A16, which stands for 1.6 nanometers. It features a critical new architecture called Super Power Rail, or SPR. It is on track for volume production in the second half of 2026.
Can you just briefly explain why that SPR superpower rail is such a massive architectural shift for the listener?
Certainly. So SPR basically shifts the power delivery mechanism from the front side of the wafer to the back side.
The backside.
Yes, and this is essential for managing the extreme current density that modern AI accelerators need. If you want max performance, you need to deliver power with minimum resistance, and SPR is how they achieve that in these tiny nodes. It's built specifically for these high-density, complex HPC products.
But if the cost per transistor is going up for N2 and A16, why are customers, even smartphone players, re-accelerating their migration? What's the value proposition?
It comes down to performance and energy efficiency. Customers are driven by the need for low power consumption and high speed. The CEO argued that even though the nominal cost per transistor is rising, the CP value, the ratio of cost versus performance gained, is actually increasing.
So you get more bang for your buck, even if the buck is bigger.
Exactly. The power savings alone in a data center or a high-end smartphone can quickly offset the higher initial chip cost.
What stands out to me most from these documents is just the sheer commitment. The unprecedented 25% long-term growth forecast and the willingness to spend $52 to $56 billion. They are planting a very expensive multi-generational flag in the ground for AI.
They are defining the global maximum capacity for advanced AI silicon. TSMC is spending that money not just to build fabs, but to narrow the gap between demand and supply. A gap they explicitly expect to remain tight through 2027.
Right.
This level of investment is necessary because of the long, complex cycle. 2 to 3 years for product design, 1 to 2 years for the fab ramp. They are betting that their technological lead and their ability to execute will keep any competitors at bay.
So the bottleneck remains TSMC, and it just takes years to fix.
Precisely. They are investing today for the 2028 and 2029 environment.
That brings us to our final thought for you, the learner. The documents show that TSMC's leadership believe this AI megatrend is, quote, endless. If silicon supply truly is the global bottleneck, we know the colossal capex spending today won't deliver the bulk of that wafer capacity until 2028 or 2029.
Mm-hmm.
Given this inevitable 2 to 3 year lag time, how does that delay affect the actual pace of global AI development over the next 2 years? What innovations, perhaps in software optimization or different hardware architectures entirely, might fill that capacity gap while we all wait for those A16 wafers to finally be delivered? Something to think about until the next deep dive.